Hello all, hope you're having a nice Saturday. I'm creating a new series in which I'm gonna be talking about ARKK. It's the very well-known CATHIE Woods ETF, the ARK Innovation Fund. And in this one, I'm gonna be talking about the individual holdings of this fund, and we're gonna be making separate video to discuss and analyze each one of those, at least the top 10 ones or the ones that have a large holding inside the fund, because you will see here that in the top 10 weight over here are the first ones that we're gonna be analyzing. And today we're gonna be starting with Tesla, which is holding about 8.36% of the fund really right now. And first things first, and in case you are not aware of the ARKK fund, where have you been hiding? Is the first question. But if you are aware of it, you should have seen that it has actually skyrocketed. It has been skyrocketing for a while actually, starting from about $34 over here and then going higher and higher where the market was ripping. And then, at some point, there came the downtrend. And right now, the fund is actually sitting at $71.90 here. And it's down 53% right now. And so a lot of people who actually bought into the hype here and started buying higher and higher over here when pretty much a lot of people were actually getting more and more aware of Cathie Woods and her holdings, may have been massively hurt over here. And we want to examine the individual stocks again just to see what current holdings the trust has over here and whether we should be putting our money into the trust right now. And so we are going to be taking a look at the companies individually because obviously trust is a collection of all these stocks over here, again with a different weight in terms of how much stock they're holding. And first things first, we're going to start with Tesla. And let me find the ticker symbol here. And I'm going to be taking a look at the overview of Tesla. You will see here that Tesla was actually down 5% in the last Friday's actually breakdown of the stock market. A lot of companies went down. But at least in the last 1 year, it has actually gained 6%. So maybe there is this stock is gonna be saving the fund, or who knows, maybe it's gonna go down lower. We'll see. But regardless of what the company is gonna be doing, we still want to examine what it's doing financially. And obviously Tesla is a very, very loved company, and I love it myself. I love the cars, but we need to examine the stock here separately from the company, because it's all about the stock. It's not about the company when we're buying shares. First things first, we want to examine the outstanding shares, and you'll see that they keep increasing here and increasing a lot. Reason being that Tesla is actually selling more and more stock to people who are willing to buy it because it's sitting at very high levels. And so they're making a lot of money funding their operations and everything else from the investors' money here, because more willing investors buying in these levels, more money for Tesla funding themselves. Now, is this a level like $860 where we would want to be entering Tesla? Let's take a closer look at the financials to see whether that's the case or not. And first off, we're going to start with the income statement. And you will notice in the income statement of the company, actually let me take it back to the last about 5 or 6 years. And you will see here that the company has been growing its year-over-year revenues very nicely. So the revenues are growing a lot. Company selling more and more and more, which is a very, very good sign and a very, very positive thing. And so the same thing with gross profit, also growing a lot. But let's actually take a look at the net income here. And you will see that it used to be a loss till 2019 here. And then the company actually started making a lot of money here. So they are growing nicely right now, making about $5.5 billion in 2021. So that's a very, very positive sign at least. Let's take a look at the balance sheet now. And you will see here in the balance sheet, there's most importantly two values that we want to be examining here. And the first one is the total liabilities of the company, which are sitting at $30.5 billion. Total liabilities being all the current and non-current liabilities. Current liabilities are the ones that need to be paid back in the next 12 months. Non-current ones are the long-term liabilities. And so the total liabilities is the total of all liabilities. And they're sitting at $30.5 billion. Is the debt pretty much that the company has. Now you will see a lot of additional paid-in capital here in the total equity estimation, just because, again, the company is selling a lot of stock, and so they're getting a lot of income from investors. This is what additional paid-in capital is, money coming in from investors, stockholders. And so the total equity of the company keeps increasing and increasing and increasing, again, having a lot to do with the additional paid-in capital here, the money that investors are willing to pay Tesla for expansion and for buying shares, really. And so, cash flow of the company. Cash from operations also increasing. So from 2 billion here to 11.5 right now, increasing a lot and very nicely as well. And also the company is investing quite a lot as well in capital expenditures for the most part, as you can understand, just because they have high expenses when we're talking about the car industry and low margins, really. Pretty much all car industries are the same. They're not like tech companies that have massive margins. So, what's going on with the financing? Right now, in the previous 12 months, really, to 2021 is that over here. The company paid back a lot of long-term debt. So you see a repay here, and here. So this is very good because it's in the billions, and so they are getting some debt off. Very cool to see. And I like this kind of handling from a company, actually. And the free cash flow also keeps increasing, 1 billion, 2.7, 3.5 over here. So that's good. What about the multiples? Multiples of the company are very high, and that's a thing that you don't want to see when you're investing in a company. You actually want to be buying a company when the multiples are about this level over here, very, very low, because you're getting more sales for the money that you pay. That's how that works. And the profitability of the company is fair. I'd say return on equity of 20%. That's fine. So the higher these values, the better it is, of course, for you. And solvency here, yeah, they paid a lot of debt back. That's good to see. And so right now the total debt to equity is sitting at a low value. And look at what was happening over here. So they have repaid debt, and also they have actually made a lot more equity because of investors, again, because investors are actually willing to buy more shares, and so that funds Tesla with more assets. However, they look like they're making money now, so that's very interesting as well. Now, one important thing here, Tesla is sitting at a $888 billion market cap, almost close to $1 trillion, really. And so, is that justified? That's the thing, because Tesla is obviously an awesome company. I love the cars. Pretty much all of us, a lot of us actually, love Tesla cars. But do we love buying the company and the stock at that price? Really, that's the question that we need to be asking ourselves as investors, and we need to be asking ourselves that today, based on what are the projections for the company and what we're conservatively make in the next 10 years or so. And so over here, you will see that the cash flow of Tesla, you can estimate it, you can use like these 2 years over here, 2020 and 21, and you're gonna get a about $3 billion cash flow per year over here. And so if you give that a multiple of, let's just say 30, which is a high multiple, especially for a car company, okay, I understand that the company is growing, but it's still a car company. And so, okay, you can say that I'm giving it a multiple of 30. That's okay with me. So $3 billion a year, give it a multiple of 30, we're getting a $90 billion valuation. Currently, we're sitting at almost $1 trillion. So we're almost 10 times that. And that's a massive difference. It's very, very expensive in terms of its free cash flow to what we're going to be paying today if we want to be purchasing the stock. And you'll see that the company also has a forward PE of 82 and an even higher PE in terms of an even higher price to free cash flow ratio, as we're examining over here. And so while I love the company, it's very, very problematic for an investor holding that company right now, because the moment sentiment dissipates a little bit and people actually kind of get hype for other stocks, and it starts to die down a little bit in chats and Reddit, maybe, or stock tweets and all those websites, you could very, very easily see the company really having a downtrend here and going lower and lower. And this is where us as investors should be having our eyes open and try to get a better value for our buck. And so if the company really loses a lot of its value and goes way lower, I would want to wait it way low to get it way lower than what it currently is, of course. I will be around, and we will be around to potentially get some. This is when everybody will be saying negative things and nobody will be liking Tesla. This is when we want to be buying it, and not right now, because it's dangerous. And there's nothing to back us up here. I mean, if the company starts going downhill, there's no cash flow that will actually support us for the next years, just because we have overpaid, and that's super important. This is why it's good to underpay, because if things go wrong, then you have a cushion. But if you overpay and things go wrong, then that's very problematic. And this is what I want to help you avoid with investments. And so Tesla right now, in terms of the ARKK fund, has performed well when you compare it to the other investments of that fund, which have been doing terribly. And imagine how lower the fund will go if Tesla starts going lower as well. It hasn't happened yet, not at least not relative to the other ones, which have gone down 20% or 30%, or not even 20. It's like 40-50% in some cases, or 60 in some situations. Companies like Roku, for example, or Teladoc. We're going to talk about those in later videos. But I wanted to give you an idea of what ARKK is holding, and why you should kind of avoid it right now, at least based on Tesla, which is the first stock that we examined. In later videos, which are going to be coming out very soon, I'm going to talk about Roku, Teladoc, Zoom, and Coinbase. And so I'm going to have separate videos again discussing whether these specific holdings of ARKK are better than Tesla. Maybe they give us a little bit of a push, or not. We'll see. So that's what I wanted to talk about in this video. Hope you enjoyed it. If you did like it, please leave a like and subscribe. I'd love to see you around. And also join our Discord channel. You can find a link in the description box below. Thank you for watching this video, and if you did like this one, take a look at this video that I made earlier, and it's about Alibaba, discussing why it's a pretty awesome investment right now. Thank you, and I'll see you soon. Bye bye.